Got a top 5 YieldMax holdings update. To jump into what exactly the top 5 are, currently we have Misty, number 1, about $4.5 billion valuation. And then secondly, we got Nvidia at $1.8 billion. We got Coney at $1.3 billion. TSLY at just over $1 billion. Palantir or PLTY at $600 million. And those are your top 5. And then we'll give a little breakdown of Hooey as well. That's $250 million fund currently speaking. So we'll dive into what their holdings are for Hooey. I just want to take a look at it. It was introduced in the S&P 500, so there's a lot of movement in the underlying equity. I want to show how that impacts the different components of these YieldMax funds. Jumping in right away, go to the top fund, Misty. Misty here, if you go to the in-depth tab, or if you go to the main tab, this should give you a breakdown of the distribution per share over time, for example, as well as the price plus cumulative distribution over time. So Misty has been a pretty good fund overall, and a very popular fund, and definitely one of the most bought funds. But as far as how it's structured for today, and we'll dive into this for each of the top 5, I got the positioning matrix here. It shows you basically, give a little zoom out to make sure we get the full look. It shows you the strike price here on the x-axis, and then each one of these bars is a representation of the number of contracts that are sold at the different strike prices. And then here, anything above or a positive on the y-axis is the number of calls bought. So you can see clearly the Misty fund is employing a credit spread method for selling calls, but then also buying calls at a higher strike price. Currently, they have the most, or I guess if we take a look at MicroStrategy, the underlying stock, the x-axis is of the MicroStrategy, the underlying equity. So currently, MicroStrategy or strategy is trading at $326.99, which is roughly simulated by this black line. The current price that's moving all the time is slightly below the chart in case you want to reference that. And then we have Misty, the actual YieldMax ETF fund, trading at $15.38. But the underlying equity is down here, and it shows you which contracts Misty, the fund, or the fund managers have sold to generate their weekly option premium, and which ones that are bought. Overall, the most that are bought are at $340, $345, $350, and $352.50. These all expire at the end of the week. And additionally, this red line, what are the red lines? We got several red lines. We got one at $330, we got one at $345, one at $375, one at $385, $395, and finally $410. Those are the strike prices where the synthetics are structured. So when they buy a call and sell a put in order to create a synthetic position in the underlying equity of strategy, it is set at a particular strike price. So in this case, they actually have 6 different strike prices where they have their synthetics set. All of them are above the strike price or the stock price right now. Therefore, if you look at how the fund is made up on a per share basis, you can see that the synthetic position overall is a negative because the stock price is below every strike price that is set for a synthetic. So currently, of the $15 and change that the Misty fund trades at, they actually have $16.89 in cash, but their synthetics are currently offering a negative $1.33 drag on the fund. The other contracts are sitting at negative 9 cents. And yeah, I guess that's how the fund is made up. I like to say it has 3 different components. It has the market cap, which is made up of the cash component, the synthetic component, and the other contracts component. Other features of this that you maybe like to take a look at. So here's the position right now. If you go to the previous position, this is how they were previously structured. The last time I ran it, you can see this was back when they had their September 5th in contracts. So that's how they were previously structured. And then here's how they're currently structured. From a synthetic usage perspective right now, through all those synthetics, they have 137,115 contracts that they can sell calls against. They have calls sold against all of them, but 29,400. Of the ones they have sold, they do have credit spreads employed at 69,775 of those. And then overall, how the fund has performed over time, we can see going all the way down to 9/9/2025. Their cash position, really their synthetic has gone down, which has brought the ETF down. The yellow line here is their weekly contracts. So you can see right now they're acting as a negative 9 cent drag on the fund. Blue's their cash. So overall, when the cash moves, it's either a distribution to the shareholder, which if people that own the fund, you get those nice distribution payments, or they also use the cash to effectively, when their synthetic gets too negative, they'll use some of their cash in order to buy the synthetic back and restructure it at a strike price that's closer to where the stock is currently trading. So really, if you want to dissect these, when cash just drops, but everything else remains almost the same, or I guess when the cash and the ETF price both drop at the same time without much moving the other items, that's basically when a distribution occurred. So you can see that happening in 7/31. I think they declared one on the end of July. I think it paid in August. They also declared another one at the end of August. So you got 2 paydays in August. But you can see these downward trails right here and right here where the distributions hit. Of course, when those cash distributions hit, they did bring the ETF price down as well. But recently, their cash position has been going down. That's been basically due to restructuring their synthetic to bring it back to us, bring it back to closer to where the share price strategy currently is trading. So they've had to use some cash basically to restructure due to the underlying equity going down. But anyway, I guess that's Misty. To jump in the next one, I'll maybe go through the next one a little faster. I like to cover Misty. It's the most held fund, so I figure it'd take the most time. But jumping into NVDY here quick. NVDY, Nvidia, underlying equity, currently trading at 170. So a little bit higher than when this black line is noted here. This was probably this morning, so it's gone up some. As you can see, clearly it's up $1.91. So almost $2. So clearly the line is close, almost right where the synthetic is structured, or their 170 synthetic is structured. They have 2 synthetic strikes, one at 165. If I click the little button here, it shows you where the 165 is and the 170. And as far as their holdings, they also have the credit spread method approach. As you can see here, they got calls sold at lower strike prices and calls bought at higher strike prices. Most of their calls sold are at the 175. Most of them bought at the 182.50. As far as their previous iteration, here's how it was set up previously. It might be somewhat similar. Usually is, unless there's big movements in what they did from the previous day till today. As far as how the fund is made up, right now the synthetic is slightly positive, so it was negative, now it's actually slightly positive, and the other contracts acts as a negative 6-cent drag on the fund. So right now with those two almost canceling each other out, the ETF price is almost equal to their cash positioning. And then as far as the synthetic usage, they got 107,040 contracts that they can write. These are collateralized by their synthetic. They've written calls against all those. So they've written 100,000 and 107,040 contracts, but they've also bought 97,040 contracts. So they got 90 of what they've written. 91% of that, they employed a credit spread method, which means they also bought a call on the upside. And then for about 9% of it, they just wrote calls with no credit spread, bought at a higher strike price. As far as how the fund has done over time, just make sure everything's selected up till 9.9. You can see, I believe, Nvidia is part of Group B, so they'll be announcing their dividend here tomorrow. Their last dividend, you can see their cash position went down to $15.64, and since then it's been slowly going up. So they've been just taking in cash by selling in their weekly calls. So they went from $15.64 up till $16.17. So if you do the math, that's basically the cash they have that they could technically take and just pay to you as a distribution. As far as the ETF price, it went down to 17. Now it's at 16.40. You can see how the price has fluctuated day to day. That is, of course, primarily all driven by the synthetic for the most part, or the price of Nvidia, the price of the underlying Nvidia stock going up and down. So that is Nvidia. Now to jump to Group C holding, one of the largest Group C holdings, which would be CONY. So CONY today looking up 3.48%. That said, it is trailing the underlying equity Coinbase, which is up 5.44%. As far as why is CONY trailing the underlying equity, we take a look at its positioning. Coin it's up a lot today. So in the morning it was like 302, now it's 318. So it's almost all the way up to the strike price. So why is CONY trailing Coinbase up 3.48 versus 5.41? We sold a bunch of calls. Let's see, at 307, 310, 312.50, and 315. Therefore, as this went up, we got capped on the upside. So although it did gain, a lot of the gains were, so we had a certain percentage of them that were stuck at 307, and then a certain percentage that got stuck at 310. So CONY is underperforming Coinbase. That said, we do have a lot of calls sold starting at 327.50 all the way up to 337.50. So if Coin can keep going, we'll start capturing and trail the underlying equity 100% once we get by 337.50. That said, our synthetic, we are almost up to the synthetic. So if you look at the fund makeup per share, this was this morning, the synthetic had a negative 18 cents, almost negative 19 cents. That should be down to close to zero. So that definitely pumped the ETF price up to the 7.11 marking. And then from a synthetic perspective, basically they're using their entire collateral. They are employing 100% credit spreads. So they do have insurance on the upside and everything that they wrote. And then seeing how the different components have fared, Coinbase, of course, took that big dip. They had the big earnings dip, and then they used their cash to restructure their synthetic. But since then, I guess they paid their distribution. And then since then, their cash position hasn't changed much. And it looks like they probably use their cash to restructure their synthetic again. So whenever the synthetic goes down too much, they do take cash and basically buy it back and then restructure it at a different strike price closer to where the stock is. So that's Coney. Next to TSLY. TSLY, one of the largest of Group A. So if we look at the TSLY details today, I'll wait for it to come up. But overall, if you just look at the prices, both TSLY and Tesla are basically flat today. But from a positioning perspective, so TSLY's at 346. Yeah, 346. So in this area, they got calls sold at 345, 347.50, all over the place. Really up and down chart because I got some bought at 365 and then got some more sold at 370, then more bought at 380. So a very interesting plot for TSLY. Looks like the previous position the day before. From a fund makeup perspective, the ETF price is higher than the cash because they got a positive synthetic value currently of almost 29 cents and negative 5 cents on the other contracts. As far as their synthetic, they got calls written against all of it except for 4,175 contracts. I imagine they might write the rest of those today. They seem to be using the credit spread method, selling the credit spread for basically everything that they have sold at the moment. And then looking at it, there are different components over time. The synthetic, of course, is positive. That's basically driving the ETF price. They actually cashed in. Their synthetic was a lot more. And then basically when it went down here, part of that was because they cashed it in. And you can see it increased their cash buffer from 686 a share up to 750 or 746 a share. So that's also clearly when the synthetic goes down, they have to use cash to restructure it. When the synthetic goes up, they can basically cash that out and increase their cash buffer accordingly. So that's TSLY. And then finally, let's see. I always forget where Palantir is. I think is that a Group B? Yes, it is. Group B, Palantir, one of the bigger payers, came out at $50 a share, but it's been a pretty big payer. As far as looking at the share price, Palantir up 3.3%, PLTY up 2.1%, so some slight underperformance. As far as why, 161 is where the stock is. So you can see it's this morning is about in the high 150s. Now it's 161. So you can see some of the upside that Palantir, the underlying, is experiencing is getting capped. The PLTY is not experiencing the same upside because we did have these calls written at 157.50 and 160. And that said, our synthetics increasing in value, but the contracts we sold are getting more negative in value. That said, at 165, 167.50, and 170, we do have calls bought. So if PLTR can go up to 165, we'll start getting gains again that kind of mimic what the underlying equity is, at least a percent. And once we get up to 170, I think we'll probably be following the underlying equity 100%. Gains are basically the percentage that goes up will be the same as percentage as PLTY will go up. They got the synthetics at 140 and 160. At 161, both the synthetics are positive. So the synthetic was already positive. This is on a total fund on a per share. The synthetic was $4.07. It's even higher now, which is causing the ETF price going from 60 to 62. And then from a synthetic usage perspective, they're writing calls against everything they can. And then on a component perspective, let's see here. So yeah, the ETF price has, you see it following the synthetic. Recently, when you see the cash going up and the ETF price going up, but the synthetic going down, basically that tells me they restructured the synthetic slightly to pull out some cash. They will be reporting Group B here, so it looks like they increased their cash position. Perhaps some of that will come back to the shareholder. The last time they reported, I believe it was right here, you can see their cash position dipped quite a bit, bringing the ETF price down, but it looks like they recouped quite a bit of cash. You can pay a pretty nice distribution coming up. So that's PLTY. And then just as a final point, I did a short video on Hooey the other day, which was recently inducted into the S&P 500. So the underlying stock was basically moving like 15%. Today, it looks like the underlying equity HOD is up again, 0.67%. Hooey is actually up 0.9%. So it's the YieldMax fund is actually outperforming HOOD, the underlying equity. One thing to note, here's how they were positioned yesterday. The stock price went up to 113. Now it's up to even 118. But you can see they blew by all these contracts they sold, but they also blew by some of the ones they bought. So today, it looks like what they did is they moved all those. So sorry about that getting black, but HOOD's at 118 now. So you can see they basically bought all those back and they sold new ones at 116, 118, 119, and 121. And they got a lot bought at 125. So they restructured everything to get it above the current stock price. That said, the stock price keeps rising, so they're not getting too far away from it. The synthetic, I believe, was it negative yesterday? Now it's significantly positive, $7.53. Their new contracts that they have sold are act as a negative $1.20 drag as of this morning, probably even more now. And then from a synthetic usage perspective, they're basically using they got contracts written against everything they can. That said, they bought contracts, deployed credit spreads for 100% insurance. The main thing I wanted to point out is the fund holdings versus time. So you can see there's the synthetic. When you had that huge jump in the underlying equity, boom, synthetic went from negative $2 a share to $7.50 a share. That said, underlying equity didn't perform as well because they used some of their cash. They actually spent from $65 a share down to $62.40 a share. So they reduced their cash positioning basically to restructure their weekly contracts. So because these weekly contracts basically would have been down by as much cash they would have used, but they basically used this cash to make it so it's only $1.20 instead of probably would have been $3 or $4 negative. So yeah, that's a